Welcome to this explainer. Today, we are unpacking a genuinely groundbreaking paper by Graham Baker and Agostino Caponi. It's titled MultiCredit Calibration via Elastically Stopped Lévy Processes. Now, we're looking at a multi-trillion-dollar challenge here, accurately pricing credit derivatives and index tranches. For decades, quantitative analysts have been basically hunting for a holy grail. They want a model that can predict simultaneous corporate defaults, perfectly match market data, run computationally fast, and most importantly, actually make economic sense. Well, let's look at how Baker and Caponi's recent work might just be that elusive solution we've all been waiting for. Okay, let's dive right into this. First, we'll cover the credit pricing dilemma, then bridging two modeling worlds, followed by the Lévy process solution, simulating simultaneous defaults, and finally, beating the benchmarks. Section 1. The Credit Pricing Dilemma. That's the central mystery, isn't it? If you're pricing credit default swaps, or CDS, you're essentially pricing the exact probability of a firm going bankrupt over a specific timeline. But legacy models have a really glaring weakness. They fundamentally struggle to accurately price what happens when a firm enters severe, acute distress, specifically a rare phenomenon known as inverted CDS spreads. So to really understand why we need a new model, we have to look at exactly why the old ones fail. For years, quants have basically been forced to choose between two very imperfect approaches. On one hand, you have structural models, like the classic Black-Cox model. These are great because they tie default directly to a firm's actual economic fundamentals, like its asset value hitting a debt barrier. But there's a catch. The math makes the default time totally predictable. And because it's predictable, the model mathematically forces short-dated credit spreads to just vanish towards zero, which, of course, completely contradicts reality. Conversely, you have intensity models, which use Cox constructions. Now, these fix the predictability problem by using exogenous, randomized processes, meaning those short-dated spreads don't just vanish, but the trade-off is massive. They act as total black boxes. You completely lose the connection to the firm's actual balance sheet and economic fundamentals. So you had to choose economic sense on one side or mathematical flexibility on the other. Let's move to Section 2, bridging two modeling worlds. And here we have the formal definition of this synthesis that fixes this dilemma. Elastically stopped, spectrally positive Lévy processes. Now, I know that sounds incredibly dense, but let's unpack it using a simple metaphor. Think of the latent distress process as a firm's internal health monitor. This monitor goes up and down based on market shocks. That's your structural, fundamental part. Now, think of the independent exponential barrier as a randomized, totally inaccessible alarm bell. The firm defaults the precise moment its internal health monitor hits a new all-time high that accidentally trips this invisible wire. This hybrid approach is brilliant because it solves predictability with that randomized alarm bell, meaning our short-dated spreads won't collapse to zero. But it also retains interpretability by actually tracking a latent distress process that's linked to fundamentals. And here's the real magic, the exact computation. By removing negative jumps, the authors are able to use phase-type jump laws and Talbot contour inversion for incredibly fast exact pricing. No more approximations. Section 3. The Lévy process solution. So the paper breaks down the driver into three specific subcases based on their parameters. First up, we have linear Brownian motion with exponential jumps, or LBM plus exp, where volatility is greater than zero. Second is the Kramer-Lundberg model. This one is rooted in classical insurance mathematics, where the drift is negative and volatility is exactly zero. Now, both of these first two allow for a firm to experience a huge shock, but then actually recover over time. Finally, the third subcase is the subordinator benchmark. This is a classical baseline model used in a lot of previous literature, where the drift is non-negative and volatility is zero. The key feature to remember about a subordinator is that it only ever increases. So the crucial point here is the falsifiable distinction between these drivers. The subordinator driver models chronic distress. Because it literally only moves in one direction, the firm's accumulated hazard rises to a rigid plateau and can never, ever decline. Once things get bad, they stay bad, forever. Conversely, the negative drift drivers like Kramer-Lundberg model acute distress. What this means is a firm can suffer a massive shock, survive it, and actually have its prospects improve over time, allowing the hazard rate to mathematically decay back down. Which brings us to Section 4, simulating simultaneous defaults. Now, the authors do something remarkably elegant here to scale this up. To build the MultiCredit engine, they inject a single shared compound Poisson jump factor into every single firm's latent driver. Think of this like a macroeconomic earthquake. When this common shock arrives,
every firm's distress jumps by the same exponential amount instantly. This beautifully simulates simultaneous defaults across an entire index, but because of the unique properties of Lévy processes, it perfectly preserves the mathematical tractability of the phase-type marginals we established earlier. The underlying math doesn't break down when we add this massive macro shock.
To actually compute this in practice, they deploy a Wiener Hopf Monte Carlo simulation scheme. See, traditional simulations usually just glide through a fixed daily calendar, right? Which inevitably introduces a tiny error at every single step, a time discretization bias. But this scheme, it's event-driven. It hops directly between exponential event times. Step 1, you draw an independent exponential time step. Step 2, you check if the common systemic shock arrived in that specific window. And step 3, you update the running supremum and the firm's distress position. By jumping right from event to event, they completely eliminate the grid bias. It's a game changer. And this brilliantly illustrates the sheer power of this approach. Just look at this comparison between the Wiener Hopf scheme and a traditional fine-grid Euler simulation. For 32,000 paths, the Euler scheme requires an incredibly fine time step just to get somewhat accurate. It takes a massive 2,048 seconds to run, and it still leaves a maximum absolute deviation of 0.0052. But the event-driven Wiener Hopf scheme, it reaches an even better accuracy, a tiny deviation of just 0.0020 in approximately 40 seconds. We are talking about 40 seconds compared to over 2,000 seconds. It is orders of magnitude faster and significantly more precise. Finally, Section 5, beating the benchmarks. The ultimate test of literally any credit model is its ability to price an inverted spread curve. Normally, you expect a 5-year CDS spread to be higher than a 1-year spread, simply because there's more time for things to go wrong. But when a firm enters extreme acute distress, the 1-year spread spikes higher than the 5-year. The market is basically screaming, this company is either going to crash immediately or it's going to survive the crucible and be fine long-term. As we mentioned, legacy models mathematically struggle to reproduce this humped hazard shape. Now, what's absolutely fascinating about this visual proof is how clearly it separates the models. Look at that black line. That is the actual bootstrapped market data for a real distressed BB-rated name. Notice how it spikes right around year 5 and then rolls over and declines? Now look at the red line, which is the subordinator benchmark. It mathematically cannot roll over. It just climbs blindly up to a plateau, completely missing reality. But look at the green Kramer-Lundberg driver. It smoothly arcs up and perfectly rolls over, beautifully tracking the actual decline in the data. The real-world data definitively proves your model must be able to curve downwards. And the numbers back this up across the board. In extensive out-of-sample tests running from 2021 all the way to 2025 across massive CDX indices, the spectrally positive Lévy drivers like LBM plus X consistently record the lowest root mean square errors, just crushing the subordinator baseline. For instance, on the high-yield cohort, LBM plus X hits an incredibly low error of 0.0098 compared to the subordinator's 0.0149. It's not just a little better, it is empirically superior in every test. But I think the most staggering statistic comes when we look specifically at those rare inverted spread curves out of sample. Out of 22 observed spread curve inversions in the second year of their data, the LBM plus X driver correctly recalled 197 of them. That is a massive 93% success rate. Do you know how many the subordinator recalled? 0. Absolutely none. Exactly as the mathematical proof predicted, it couldn't see a single one. So, having completely conquered the single-name marginals, the authors finally moved to pricing index tranches. Now, why tranches? Well, because the standard vanilla index swap just pays out on each constituent separately. It frankly doesn't care if defaults happen together or apart. But tranches are different. They absorb specific bands of portfolio loss. An equity tranche takes the very first hits, while a senior tranche only gets hit in a total systemic market meltdown. Therefore, tranches are uniquely and highly sensitive to that nonlinear dependency of simultaneous defaults that we modeled earlier with our macro earthquake. When comparing joint tranche pricing errors, the common jump Lévy models just blow out standard industry baselines, like the Gaussian copula, and academic benchmarks like Duffy-Garliano. The results here are a total blowout. Even fully remarked, the Gaussian copula carries an error of 0.159 on high yield and 0.097 on investment grade. Duffy-Garliano fares even worse, hitting 0.380 on investment grade. But look at our spectrally positive Lévy drivers. LBM plus Expand achieves an error of just 0.056 on high yield and an astonishing 0.022 on investment grade. They vastly, vastly outperform the benchmarks. To really put that outperformance into perspective for you, if you tried to price these exact same tranches, assuming every firm's default was completely independent from one another, you would end up with a massive pricing error gap. But this parsimonious two-parameter dependent structure, using literally just the intensity and size of that one common macroeconomic jump, closes up to 95% of that massive tranche pricing gap. To sum up the core takeaway directly from the authors themselves, our framework dominates a single-factor Gaussian copula and the affine intensity benchmark of Duffy-Gerlanu on both indices. This elastically stopped Lévy model isn't just mathematically elegant on a whiteboard. By capturing acute distress, incorporating real structural fundamentals, and allowing exact, blazingly fast simulation of simultaneous defaults, it is empirically superior in the absolute harshest real market conditions. Which leaves us with this final, rather exciting thought to ponder. If this exact, lightning-fast hybrid approach can so thoroughly solve the multi-trillion-dollar credit index tranche problem where everything else fails, what happens when we apply this engine to the broader universe of structured finance? I mean, how might this completely revolutionize the pricing of collateralized debt obligations or credit risk transfer bonds? The mathematical door has just been kicked wide open. Thank you so much for joining me for this explainer, and keep exploring.